special guest today that is here from Home Equity Bank, which is also the #1 lending institution for reverse mortgages. This is Dayne Moyer. Thank you so much for coming in today.
Hey, thanks a ton for including me in your video.
Well, it was very nice of you to bring the Halloween treats, and I definitely learned a lot, so thank you for doing that quick video. But, you know, part of it is, and I'm really excited because I read an article last week, and it was very shocking, and I know I've been trying to think about different ways to get that information out to our clients that are really coming up to that next phase of retirement in their life, and, you know, just haven't necessarily, I wouldn't say planned correctly, but just the way affordability is going and everything else. And the article was basically that 67% of Canadians don't have sufficient retirement, right?
No.
And they're now using their homes, right, to be able to support that. And I thought it was very crucial that we talked about the 4 main ways that this product could help our clients in terms of being able to stay in their home, right? There's early inheritance options. So let's just break them down sort of one by one, and maybe you can talk a little bit about the segment we're talking about.
Well, you're absolutely right that there are a ton of folks that don't have enough for retirement. In fact, in Ottawa, locally, the average 55-plus-year-old is spending $1,000 a month, just a little under that, more than they make.
Wow.
So almost $12,000 a year is a shortfall that they're pulling out of inheritance, or even worse, they're spending on debt. And you are correct that some folks are pulling that equity out of their home to make up for it, but even worse, other folks are not noticing it and they're just expending their debt, or they don't have the resources and the experts like yourselves to talk about this option, and they're downsizing or selling their homes when they don't want to.
Yeah.
In fact, we had an employee at Home Equity Bank whose parents had a shortfall, and they said, you know what, we don't have enough to live off of, so we're going to sell our home and we're going to rent. They sold their house for about $350,000. They used that fund to pay monthly rent and expenses.
Yeah, to fund
Exactly.
their living expenses.
10 years later, they were out of money. And the worst thing about it is that house sold for $1.6 million in Toronto the year before. So they collapsed an appreciating asset of $300,000. They started renting, and they lost out on so much investment and hard-earned equity that they spent their entire lives building to step away from because they didn't have experts consulting them on options. So it's a completely reality, and you're right, there are 4 ways of using it, and we'll get into it.
Yeah, and I think you touched on a point about, you know, buying the real estate was the smart way to do things. Right, and Canadians are amazing of paying off their mortgages, right?
Correct.
I mean, they will do anything to pay off that mortgage, especially when that generation has gone through, you know, depression. They've gone through 18-21% mortgage rates, right? And today we're just not at those rates, right? So we really have to figure out ways to build tools, right, to take that asset and make it a tool and not necessarily product, and forget about interest rates because we're not at 21% right now, right? And really focus on how we could take advantage of what the rate environment has been over the last 10 years, right, in terms of different things that you can do. So we wanted to bring the expert in to talk about the 4 ways. So we'll start off with the very first one, which is early inheritance. So how does that work with somebody who's got their home paid off or almost paid off, they're in retirement?
Look, more and more people are warming to the moniker, you can't take it with you. And there are a lot of folks who spent their entire lives to build their home and their wealth, and they do want their kids and their grandchildren to benefit from it. What better way to see them use it? A lot of our clients, you know, somewhere in the 25% mark, they're coming and they're getting a reverse mortgage because they want to see their family use the wealth that they created, as opposed to sit on it and never get a chance to see whether it be their grandchildren getting a first home because they're having a baby. There's nothing better than seeing that happen. So a lot of our clients are doing that. They're taking the family on a vacation. They're helping with down payments, which is a huge thing, right? Especially with affordability in the Ontario market, in Ottawa. parents and grandparents are intervening more and more to make housing affordable, and using a reverse mortgage is very beneficial, because what a lot of people don't realize is that when they cash out their investments, if they're living off their old age security, if they're living off of their benefits, those are going to almost disappear the year after they take those funds out. So unfortunately, we have a lot of fantastic accountants, fantastic investment planners, fantastic mortgage brokers that don't bring that up in the transaction, right? So the children or the grandchildren are looking to purchase a home. Us as mortgage professionals go, hey, can mom or dad or grandma or grandpa help out? Then you can afford this property. And when they say, yeah, absolutely, we'll take out the money, as professionals, we do have an obligation to go, and by the way, let's have a quick high-level conversation about what's going to happen if you pull those funds.
Sure. Yeah.
So it's all about figuring out that balance and going, we do have another solution. If you're living off the dividends of your investment, if you're living off of OAS, pulling those funds might have really negative impacts. There are other ways and better ways in some cases of doing that.
And we really want to help, right?
Absolutely.
I mean, that's the thing, and you're looking at it going, if I take my money out of investments, which is what I've been taught to do, right? Is after tax money, pay all my bills, and then take my last bit and stick it in investments, right?
Yeah.
And then you get, 40 years and later, and you want to help your grandkids, and where do you get the money to do that?
That's it,
right?
exactly.
So that's really important how that product works. So. Do you have a quick example of somebody that you can think of?
Absolutely, yeah. I mean, there are two, right?
Yeah.
There's the folks who very, very, very specifically want to spend some time with family, and there's absolutely nothing wrong if you're living a comfortable life, but you want to go on the cruise, taking some funds and doing it, because there's three stages when you're older. There's the go stage, there's the go slow stage, and there's the no-go stage. Personally, I can tell you that my grandmother, who just turned 85, always planned on taking us for a cruise, and then this year she was hospitalized and she doesn't have the health to travel anymore. So I can tell you right now that, on that side, I know it sounds a little superfluous, but those memories are long term. And I think, if we can use a mortgage product to bring family closer together, to have that opportunity to have a once in a lifetime trip, do it. And then of course, like I said, in real estate, when I'm doing it all the time, talking about those funds for down payment or helping buy a piece of real estate.
Yeah, and I think that's a big one, because I've seen it a million times where, and it was even with my own grandparents, they want to help, but they just don't understand how to do it. Or I watched my grandparents as well, put everything away so that they could leave an inheritance, but how are they living in order to do that, right? And not realizing you can spend it now, you can do it now, you don't have to wait until that. And we're not all sitting around waiting for it either, right? So let's have some quality time to do that while they're there.
And I'm glad that you brought that up, because our company has a consumer division, and what we find is that one of the biggest things that we hear from folks when they call in are, I'm struggling with money and I'm struggling to pay my bills. We have folks that call, they're using a food bank instead of buying groceries.
Wow.
And it's because they go, my family will inherit this home. And when we have that conversation and we say, if your family knew how you were living, they would want you to take the money. And they do, and it's true, they do. We had one amazing woman who called in, and she was really nervous about a reverse mortgage. She called and asked for information. She didn't call back. And then her granddaughter was over for lunch, and they turned on the TV and they saw an ad, and she said to her granddaughter, I've been thinking about doing this, money's a little tight. And her granddaughter said, do it, let's call right now. Let's call right now. And so they said, once you do this reverse mortgage, what are you going to do with the money? And it wasn't an insignificant amount. I think she was taking about $50,000. And so put that in perspective, she's taking about $50,000. What are you going to do with the money when you get it? And she said, I'm going to go to the movie theater and I'm going to get popcorn with butter. This is what our grandparents are living with. They're isolated. They're not going out. It's because, come hell or high water, they're giving us this house. And the reality is, we don't want it. So, that's just
and if
another
you're planning
example.
right now, then you won't need it. Right. Hopefully, as they.
And what's really cool is that, you know, the way that reverse mortgages work is that there's always equity in the home. In fact, we guarantee that no one will inherit debt, right? We're the only Canadian financial institution that puts a guarantee that goes, if the real estate market crashes, if the value of your home is ever lower than the loan, we will forgive the difference.
Okay.
No one else is doing that. And so literally, you know, older Canadians can rest easy and say, not only should there be equity in the home even though I've taken this funds, even if the real estate market crashes, I won't be leaving debt, right? Whereas the folks who are not taking the money out of the home, but they're using credit cards, lines of credit, stuff like that, that's a completely different story, right?
Yeah,
and it's possible that the estate is going to have debts that need to be collected. So that's an important thing to think about too.
Yeah, very good points. Okay, so the next one would be maintaining or improving lifestyle. I love this one because we did talk a little bit about that.
Yeah.
So maybe you can share a bit of that. This is probably one of my favorite ones.
I mean, it is literally as simple as we're spending $1,000 more a month than we're making it. And where that fund is coming from is 20% interest credit cards, 7, 8, 9% interest lines of credit, or pulling out of investments too quickly and they're going to disappear. The issue is that a lot of older Canadians feel like they're completely alone in this. And so they're going to do all of these different things to try to band-aid the situation because they feel ashamed. What they don't realize is if they called someone like you know, you don't sell home equity bank mortgages, you just sell mortgages. You have an opportunity to look at it and triage it and go, look, we can get rid of all of these interest rates.
Yeah, that's huge.
And we can consolidate the 20% interest rates into something that's way lower. And we can get you in a position, because we do have a product like this, where we're going to give you $1,000 a month. You know, as long as that equity is there, there's no reason why we can't create what we call a home pension, right?
I love this product, by the way. Do you want to talk a little bit about the home pension? Because
sure, absolutely.
That's a really, and you're saying that's the one that's coming.
Well, it's been in existence for a long time. We call it the income advantage product. But it really, in other places in the world, it's prominent. In Japan, it's actually used quite a bit, and they call it a home pension. So one way to really wrap your mind around the product is to think of it that way. You know, especially in Ottawa, we take for granted that it's less than 50% of people that have pensions, right? And
I don't have one.
That's it. You know, yes, we're a government town, but I believe it's 37% of people are working for the government. The rest aren't, right?
And most people that are coming on with any of the generations today, right, are coming on to new positions, and they're not offering any pensions at all. So this is a big deal.
This is a big thing for boomers. In the 80s, a lot of people gave up pensions for higher salaries, and we're just now starting to see the ramifications, like not having enough retirement investment, stuff like that. And so, you know, there are lots of ways that you can take funds out of your home, and there are lots of people that are equity rich and cash poor. The nice thing about an income advantage product is that you're only paying interest on the money you take.
Which is amazing, right? Because you're not having to be stuck with making those reverse payments on the $100,000 or $200,000 that you're taking out. You actually structure it that you're just paying interest on the release of the funds that you're setting up to take out quarterly, monthly, right? And
the great thing about our product is that there are never payments. We don't expect payments at all. And what we do is we compound the interest on loans so the loan grows. But what we want people to think, and I know it's a funny way to think of it, you're going to let the house pay the interest. And what I mean by that is your house is appreciating, it's growing that value. The appreciation rates in Ottawa are higher than the interest rate we charge. And so you are still paying the interest. You're just letting the house pay it instead of taking it out of your pocket. And so the income advantage and all of our products, there are no payments required. If you want to pay the interest because you're used to paying the interest because that's the way you were raised, because that's how mortgages work, you're more than welcome to. But if you don't want to make a payment at all, there's no obligation to do so.
Yeah, it's a really flexible product, right, in terms of making or not making or what have you. So, okay, we're going to talk about the third one, which is unexpected expenses. So there's probably more of these, right? It doesn't matter how much you plan or how much you budget or put away for a rainy day. And I can give you an example where, and I'm sure so many people can identify this, but the biggest one is what happens for in my life, this is probably the most truest to me, is what happens when you have someone in your life that has, maybe not be yourself, that has an unexpected lifestyle change, but what happens when it's someone you love, right? We tend to want to take care of the people we love more than we take care of ourselves, right? So what happens if it's a family member, a child, right? A grandchild, that they have an unexpected situation in their life, or maybe you do. Maybe you get sick earlier than you thought you were going to, right? And you need to be able to help with meals, respite, taking time off work so that you're not stressing out and getting 4 months behind on your bills. Maybe your current job situation won't even allow you to take the time off, right? And I think even, you know, when I look at the generation, we don't want people to come and help us, right? We always feel terrible. We love to give, but we hate to receive, right? And I think this is huge because it can help to take care of some of those things that are unexpected. And it could even be just as something as your house is dated and falling apart, or, you know, you need, it's been 40 years since you've put a roof on, or a septic system, or anything. So maybe you can talk a little bit about the unexpected expenses.
Listen, you're absolutely right, and you know, we've had a government change in Ontario. It has impacted the healthcare system, and what we are seeing is less and less medications that are covered. Older Canadians are struggling with this, and you know, CBC is talking about this all the time. Doctors prescribe medications, and those prescriptions aren't being filled. This goes back to your family just wants to spend amazing time with you. And if you're an older Canadian who is equity rich and cash poor, you may not be taking care of yourself or taking the treatments you need to because you don't have the pharmacare that you need. That's an unexpected expense that people use this for all the time. And I can tell you right now that everybody just wants to see people healthy. The other thing is that, you know, people don't realize that 92% of older Canadians don't want to leave their home. And there's a bunch of reasons for that. One is memories. Two is neighborhood. A lot of people underestimate the value of a neighborhood. And when you've lived somewhere for a long time, you're used to having the pharmacy nearby, the doctor nearby. Maybe you have an accessible, you know, podiatrist who helps cut your nails. My grandma does. Downsizing is never going to happen in the same neighborhood.
No.
And what happens is that, you know, the roof goes or the furnace goes, and family tends to swoop in with our older Canadians and say, all right, Mom, like, this is the evidence we needed. This was the moment we were waiting for to tell you can't take care of the house anymore. You gotta move, right? Not only if you make that decision are you going to sell your house for way less than it's worth, right? And so all that equity you built is going to get robbed and decreased because your house is going to pass an inspection, and you're going to get whittled down until a contractor is buying this place just to flip it. Don't let someone flip it. It's your home. You get the equity. But also, if you want to stay in your home, we have no problem lending funds to make sure that you can keep it safe and up to date. Right?
Yes, this is the product we wanted to talk about. This is another great product.
Yeah, and that
you
one
guys have on your shelf.
That one is coming out, early next year, which is not far now, right? We're less than 3 months away, and that's going to be our first short-term product, which is for especially, you know, when realtors or family are identifying that the house is not up to date, and we just want to update the house and get full market value when we're selling it. Lots of older Canadians are walking away from a familial home that is mint, right? It's so well cared for, it's immaculate, and it's got a mustard fridge.
Yeah, stoves, which, by the way, is all coming back into the new fads, right? As we're all looking for that stuff to put back in our house.
That yellowed wood cabinetry in the kitchen, or maybe that old carpet, right?
Yeah.
The reality is that costs no money, right? When you've got a good, honest contractor, you take a quick trip to IKEA, test the marriage, and then you've got an up-to-date home, and you're selling it for, you know, at some times 3 to 4 times dollar value of the renovation you put into it.
And let's be honest, like, right now we're in a market in Ottawa where you can almost barely put the for sale sign out, right? But what happens when that shifts again? Because Ottawa tends to move in every 10-year increments, right?
Yeah.
So if depending on what market space you're in, it may not be that easy. So you do have to sort of separate yourself and stand out, right? And with affordability getting to be a little bit more difficult and challenging, not everybody wants to buy something that they feel that they have to, put 100,000 because they don't have it,
Yeah.
right? They're saving the down payment. And even if you do a purchase plus improvement, you're still capped on how much you can turn over to that property, right?
Exactly, yeah.
Yeah.
And I'm going to go back really quickly to unexpected expense because I think there's one more that gets forgotten about all the time but is really important.
Mm-hmm.
And I'm just going to talk about it quickly is special assessments.
Oh yeah, that's such a big one.
So
That's a big one.
we've got a lot of older Canadians who are living in condos,
Mm-hmm.
and we've got a lot of fantastic condo corps. Ontario's great because there's a regulatory body. It
Mhm.
requires the members of the condo corp to go to courses. Other provinces don't have that.
Mm-hmm.
But even with that, we see special assessments coming up.
Mm-hmm.
And sometimes we see a building where all of a sudden there's a bunch of inventory, and it's because these older Canadians can't find the funds to fork up extra money to stay in the building.
Mm-hmm.
What that ends up doing is it undervalues the condo.
Yes, it does.
It has people coming in and buying these condos for cheap.
Yeah.
But the fact is we have no problem doing reverse mortgages for special assessments. So if you're an older Canadian who's living in a condo and all you need is 15, 20 grand because the special assessment has come up, the building needs to be updated,
Look at Montreal Road was 55,000.
55,000 exactly. And so it's so important that we're making these products available to these people because really, like you said, you guys are solutions based. You guys are about creating an opportunity for a mortgage to help people be savvy investors, to help people have secure housing, and this is a component of that for sure.
Yeah, no, that's a huge one. Good point on the condo. So I would say that the fourth one, this one I really like because there's a lot of opportunity in it, and it's augmenting your actual lifestyle. So this
Yeah.
is huge, right, for our baby boomers who don't necessarily want to downsize,
Mhm.
right? Or they need to make a lot of changes to their current household, again, neighborhood. So maybe you can talk a little bit about that.
Yeah, so I mean, augmenting lifestyle, it really is for those go individuals. It really is for those folks who, they've worked really hard for the money that they have, and maybe they're comfortable, right? Maybe they do have a pension coming in, maybe they did put aside investments, and at least right now their investment planner is saying, look, you've got a 50% chance of living to 95, and if you do live to 95, we can keep this gravy train rolling. We're not living, lavishly by any stretch, but we can afford groceries. Maybe we can get a new car when the car breaks down. But we're not getting the opportunity to, go to Florida in the wintertime.
Mm-hmm.
Maybe go on a little bit of a trip somewhere else. Maybe participate in that class that you can't afford to participate in, right? What we see is, again, this, older Canadians experiencing isolation. Older Canadians are more at risk for Alzheimer's, for dementia, and they're not getting out of the house, right? And so if $1,000 a month is going to be a difference maker between just making it and making it, what's the point?
Mm-hmm.
Why did you work your whole life to retire to just make it?
Mm-hmm.
Right?
Yeah,
You
it's
worked
supposed to be the golden years, right?
Exactly, and so that's what this product is really for. It really is that golden years product of essentially saying, look, you're still not going to leave your estate with debt.
Mm-hmm.
You're still not going to end up in a situation where someone owes money for you, but go have a little bit of fun while you're active.
Mm-hmm.
Go have a little bit of fun while you're mobile.
Mm-hmm.
Keep your brain active, be part of your community because you deserve it,
Mm-hmm.
right? And we will always, 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 regardless of the age of our clients, lend out a conservative amount to ensure that they can stay in the home their entire life.
Yeah, and I think some of the examples we were talking about just before we started the video was, one is, what if you wanted to, like, a lot of bungalows are scarce, right? It's very difficult to get, everybody wants to build straight up, right?
Mm-hmm.
And they are, because when developers are purchasing the land,
Yeah.
right, they're trying to put as much property on one 50-foot lot. So bungalows are getting a lot more scarce. You don't see them as often. So the older neighborhoods, of course, have gone up quite a bit in value. But what if you could stay there and finish your basement, right? You could make a secondary dwelling,
Oh yeah.
right? I mean, you could do that for what, $40,000-$50,000
Easily.
and easily collect a $1,500 a month rent, right?
And what's so much cooler about that is that you're also augmenting real estate value in such a meaningful way. That if you're the kind of client who's going, I would never borrow against my house because I want to leave this nest egg to my kids,
Mm-hmm.
it's silly to not invest as much as you can into that nest egg so that the value is as high as possible. So you're absolutely correct. And here's the really cool thing about the company that I work for. If you Google us, if you look at our site, everywhere on our site talks about the kind of thing you would talk about as a mortgage broker, all of the better options out there before a reverse mortgage, before a home pension. So things like a home equity line of credit, things like a conventional mortgage, they're lower interest rates. And there are folks who are older who qualify for those things. Take them, right? If you're someone who absolutely wants to stay in the home, if you're someone who will not qualify for the house after your spouse passes away.
That's a big one, is qualifying, right? Tell how easy it is to qualify.
So it's very, very easy to qualify because our requirements are based on equity. We want to make sure your property tax is up to date. We want to make sure you have home insurance. We want to make sure you're taking care of the property. That's it.
What,
right?
can you pay out taxes?
You absolutely can.
That's another big one.
As long as there's enough funds in there, right? So with B20, a lot of older Canadians are really struggling with major banks.
Yeah.
They've always been approved. They walk in, it's not their fault, but the major banks just go, I've got nothing.
Your qualifying rate, you don't qualify anymore.
We've
right?
got debt service ratios. We've got to consider 3% of debts. We can't help you. We're cutting your pension in half. We're disrespecting the income you're making. And that's the other thing you hear all the time. Why is the bank I've been with for 40 years
That's a big one.
telling
Bank
me
loyalty, right?
that my pension is worth half? Why are we arbitrarily cutting it like that? And so this product, it really isn't about income. We don't worry about income because you don't have to make a payment. It's just about, is this a good home that's well taken care of and all the bills up to date? And as long as they are, or if we can get them back up to date, we're good to go.
Right, so taxes owing doesn't matter, credit doesn't matter. It's really a home equity based product. It's very easy to get the application in, right? To see how much you qualify, we put it through the calculator, we let you know what you can access, and we get an appraisal, and it pretty much can start. So what's the best age, right, that you can get into? And
so you've got to be 55. If you're under 55, we're just not going to help you out. And that's because we intend for you to stay in your home your whole life, and sooner than that, it would just capitalize faster than the house was worth, right?
Yeah.
The ideal age is really based on what we're trying to do.
Yeah.
And I hate to cop out on that, but at 55, most Canadians are still working. At 55, most Canadians do have a bit of a mortgage, right? And so depending on the lifestyle that they want, they're going to consult with you, and you'll either fit them in a reverse mortgage, or the really cool thing to do is to talk to 55-year-olds about the plan to use a reverse mortgage later. So if you're 55 or nearing it, that's the time to start the conversation.
Okay. And just the last one I really want to bring up was how you did the subsidizing, right, for the actual pension income. That was a great little story that you had.
Yeah, absolutely.
Because again, it re-triggered back money that they didn't have the ability to access, that they paid into their entire life, right?
Yeah.
So talk a little bit about how OAS works.
Yeah, I mean, the CRA, right? Like, they convince you to put your money in RRSPs. When you try to take it out, they tax you up the wazoo, and they take away all your benefits. We're finding, regardless of whichever government, conservative, liberal, let's not get into that, we're finding that benefits for older Canadians are not what they need to be. So lots of folks are taking the money that they need to live off of out of their investments. The government will tell you that you've got a high income. The government will tell you that you're really not eligible for old age security, and your investment planner is going to tell you the legs on your investments right now are 10 years max. We don't know what we're going to do in 10 years. So a lot of Canadians, they're going to use those funds for 10 years and figure out later. They're going to not get OAS benefits. They're going to be taxed heavily on those funds. They're going to lose a lot of investments. We've got a better solution, which is to use what we talked about, the house pension, the income advantage program. Take funds out of the home. You can balance them with your investments, or you can just take funds from the home. It's whatever your investment planner, your mortgage specialist really thinks is a good plan for you. But let's say you're taking $4,000 from your investments a month, and it's going to last for 10 years. If you cut that to $2,000 a month, and then you take $2,000 a month out of your home, you're only taking $25,000 out of your home a year. So there's a lot of value in your home. It's going to keep going.
But what does that do? It triggers.
Exactly. It's turn your investments into a 20-year investment.
Yep.
Suddenly now you've got 20 years that you're going to be able to live off of it. And it literally cuts your income in half according to the CRA.
Mm-hmm.
So the
So
money
you get the recapture.
exactly
Right?
the money that you're taking out is taxed at a lower bracket. Your old age security benefits are growing, and your income is actually higher,
Mm-hmm.
even though you're taking the same amount per month into your household income.
It's, yeah, and you deserve to take the money out, right? You paid into it.
Yeah.
Excellent. Well, I really appreciate it. We're probably going to do another video at some point about the myths of reverse mortgages and home pensions. But thank you so much for tuning in. You can always give us a call, 613-266-3570. Thanks.